Good afternoon. All right, we are ready to get started with the second half of our symposium. Our speakers for this panel are Nicolette Kahen and Charles Huang, and I will allow them to introduce themselves, but please join me in welcoming them.
Hi, everybody. My name is Nicolette Kahen, and I have a company in the space called Artemis. I'm building a art exchange allowing for the fragmented sale or trading of fine works of art, similar to buying and trading shares in a stock exchange. So I started in blockchain probably about two years ago, nearly full time, but it's been about 4.5 years that I've been following the space. And the reason that I got interested in the space is because for years I've been trying to figure out if there was a possibility of using existing assets as a form of currency to be traded in a marketplace and not really having to have a use for currencies backed by commodities or resources or what have you, but can you actually use those actual assets and resources as a way of having buying power? So blockchain became the perfect catalyst to kind of make that vision come to reality. So I started a company called Artemis, and with Artemis, we're essentially going to be building a stable currency where the asset itself is traded and not backed by an ICO. So instead of attaching an ICO, where the ICO will eventually negate the value of the actual asset, we're leading with the asset to have the power for the marketplace.
Hi, everyone. My name is Charles Huang. How's everybody doing after that turkey crypto fan? Sorry, I'm just kidding. It's a crypto joke. When you get in, you start making lots of crypto jokes. It's the thing. Like, I need a crypto nap right now. You know what I'm saying? Anyway. So how I got into blockchain was very accidentally. I mean, I was a nerd. I was a geek. I went to MIT. I studied material science, electrical engineering. My first job out of college was at a big software company called Palantir, where I worked on cybersecurity and anti-money laundering. And before I was working on anti-money laundering, I was messing around with Bitcoin in college with my friends, just for recreational stuff. Then the price went up, and we lost all of it, and it was just like very kind of like distressing. This was around 2011, 2012. Then the Ethereum white paper came out talking about smart contracts on top of the blockchain. And that was interesting from a geeky perspective, but professionally I wasn't very interested in it at all until last year when after leaving Palantir, I started my own company in 2014 that focused on nonprofits and technology. And Palantir really sold me on the whole like save the world with software thing. And I was very much enamored by that, thinking like, oh, there's this whole business of saving the world called philanthropy. What does the software look like? And I don't know if any of you have worked in the nonprofit space, but hasn't shown up yet, really. So one of my largest clients, Fidelity Charitable, last year in August, they asked me, they're like, hey, Charles, you're the nonprofit money guy. And I was like, no, you're the nonprofit money guys. What are you talking about? They said, yeah, but you probably understand a thing or two about blockchain, and we're trying to figure out why all these charity token ICOs are failing. Can you help us figure it out? And I was like, you gonna pay me? And they said no. But the point is when I did the whole study and I delivered my report, I found out that all these charity tokens, they are all solving the wrong problem. They're all solving the same problem. They're all doing a really good job solving that problem, and it's the wrong problem. Whereas with Bitcoin, you can decentralize a checking account because you don't need any sort of like intelligence. All you need is basic accounting to manage a checking account. But when you're directing funding that is directly supposed to save people's lives, when the misdirection of funding means more people die, then you need research, you need data, you need expertise, right? And that's what I delivered to them. Like with all these charity tokens that are trying to decentralize the Gates Foundation, it doesn't really make sense because I've been working in the space for 4 years and I don't know how to solve malaria. Do you? You know how to end homelessness? No, but there are organizations out there that have been doing this research for decades that even though the problems are still there, they're still a lot farther ahead than the rest of us, right? So this led us to the discovery of a new business model we're calling the company Panda Chain because I'm Chinese and I love pandas. No, Panda stands for Protocol for Auditing and Distributed Administration. And it's this product that takes it's a combination of a centralized cloud-based application that we're all used to with underlying smart contract and blockchain infrastructure that will actually deliver on the promise of nonprofit transparency and accountability. And when it really comes down to the brass tacks of this nonprofit world, nobody opens up their databases. I worked at a database company, right? Nobody wants to share their data because these small operating foundations, like when Gates gives $10 million to a malaria charity, right? There's a bunch of other malaria charities that are all fighting for that same grant funding. So they're not sharing best practices. They're not sharing tactics, right? And then Gates is competing against a few other handful of like big box name foundations. So they're not sharing tactics with each other either. They're not sharing their data sets because they all want to be the first foundation to solve it. All right, and the beauty of blockchain is that it enables complete data transparency in only the data segment that you want. Right? And that's a very important feature where you have business ecosystems where suppliers and vendors have competing incentives, and they all share this opinion that with a sufficient amount of transparency, these business transactions would happen more frequently with more efficiency, with less friction. But when no one wants to open up their database because everyone's got competing incentives, then the industry is stuck in the Stone Age. This happens with supply chain use cases, with auditing use cases, and just because of my fascination with the nonprofit world, it works very well in the nonprofit space as well. The other project that we're working on as a component of Panda Chain is called SORT, S-O-R-T. It stands for the Scientific Output Reproducibility Token. And I guess the backstory on that is, there's a lot of academics in the room, right? With academic research, the only financial incentive, the only way that a professor or a scientific researcher gets a paycheck is grant funding. And the way that these grant funders, Gates, Ford, the NIH, the Department of Energy, the way that they select which professors and principal investigators to give that money to is based on the number of journal articles they produced, not the quality of that science. So now you have this mass proliferation of bad science where you have 1 in 5 journal articles. Like the journal are like Science, Nature, Genomics. These most famous journal articles, only 1 in 5 are reproducible. Yeah. So for example, the Pfizer Foundation, a few years ago, this was 2013, there was a big article in The Economist. I think it was something like $150 million or $250 million that they invested to reproduce the 17 most cited stem cell research articles. They spent all that money and only 2 of them were actually reproducible. But those other 15, they're the most cited stem cell research articles, and they have developed all kinds of medical treatments based on that science, based on that basic science. Yeah. It's a big problem. Yeah. I hate those Ivy Leagues. Hate them. MIT's not Ivy League, okay? We're out. We're out of the club. But so it's a $2 trillion a year problem where we have junk science, and save the rest of the questions for the end. We'll get through and talk about how Nicolette's platform and design for asset tokenization is going to create this global market of stable currencies, and how all my projects are going to make money on her project.
So talking about asset tokenization, a lot of people in the space, I think, confuse cryptocurrencies as, the incentive for blockchain technology. Whereas I think both Charles and I agree that blockchain technology and cryptocurrencies are 2 separate entities, right? Cryptocurrencies is the first, strong beta for blockchain technology. I think the issue with the space is that a lot of people are leading with the beta and not leading with the technology. They're not focusing on the token economics. They're not focusing on what should be driving these new companies, these businesses, these practices. And because of that, you're seeing a lot of high highs and a lot of low lows, right? A lot of the reason that people are getting involved in this space, unfortunately, is because of FOMO. Not because they understand what's actually happening, not because they really care about decentralization or what that means, but because, oh, this is a cool thing and I don't want to miss the wave, right? So how do we change that where you allow people to kind of get inside this space while incentivizing people to adapt decentralization and really separating as my mentor says, the shit coins from Bitcoin. So there's a lot of these ICOs that are in the space right now that are the value of them has no rhyme or reason for why it's established at that price, right? Except for market makers or market manipulators or share adoption, right? But what that does is, because of these high lows and swings, we realize that there's no base floor in crypto at all, right? What's actually backing these currencies, right? The reason that the US dollar has value and is considered a global stable currency is because of what it's backed by, right? Sovereignty, property, weaponry, right? And other resources. We have the strongest nukes in the world, so we have so-called the strongest dollar in the world. You can go to any country in the world and your US dollar has value, right? There's countries where their currency is not backed by their own commodities, but by freights and freights of US dollars sitting in their bank accounts, right? That's crazy. But the US dollar would have no value if it wasn't for what it was backed by. So why not lead with that, right? So that was my approach to this space. Why not lead with what we're backing currencies by as the forefront of actually having them be, so we don't really need a use for currency, right? So came up with a model to actually tokenize assets and allow people to buy and trade fragmented shares of those assets, similar to buying and trading shares, like I said, in a stock exchange. But by doing so, you actually create a global currency, or a stable currency, where every asset, including our personal data, has value, right? Has value that could be translated, many times over.
Yeah, and I kind of want to touch on this point a little bit that she made, where there's this bifurcation of the cryptocurrency market and the blockchain technology itself, right? So Nicolette came into this blockchain world from the art world. I came into the blockchain world from the engineering world. So one of my angel investors in my last company is actually a core Ethereum developer. He made entire sections of the Ethereum virtual machine. And when my client gave me this task, he said, figure it out. I've sent an email to my network. I said, who can give me a good technical understanding of this? He hits me back. I'm just like, Dave, what the heck are you talking about? All right, and so began my boot camp. It's like every 3 days we'd have a phone call. He'd give me some homework. I'd call him back. He's like, okay, it's done. He would give me some homework. I'd compile it. Right. I did 2 months of this before I interacted with the blockchain community at all. And when I got into the space, when I started going to I went to BlockCon in LA, went to all these different little conferences and meetings, and I was just appalled. You're all con artists. These people are bold-faced pitching me Ponzi schemes with smart contracts. And it's like, do you realize what's going on here? And they're like, yeah, no, you just buy the token. Okay, what do I do with it? It's like, oh, no, you don't want to sell it. You don't want to use it, because other people are going to buy the token. And it's all verified on the blockchain, and it's all trustless and cryptographic and da-da-da-da-da, buzzword, right? And I'm just like, oh, my God. So that kind of I dipped my toes in, and I got back out. And it took a while. It took a while to find the serious technologists, to find the serious people that are really pushing this technology forward. Because from a technical perspective, this is the next evolution of the internet. And
right.
You covered that in the first session a little bit. It's like, there was computers that were not connected. There were local area networks that connected some computers. Then we had the global internet. And as the internet scaled, data packets weren't moving efficiently through that network of computers. So they had to come up with the transfer control protocol, TCP/IP. TCP/IP is what blew up the internet, is what made it actually work, right? But the issue is when I'm on this side of the internet and I'm sending something to that side of the internet, it has to pass through all these gates, all these centralized servers, and there's no way for the person on the other side to know if that data packet that I sent, if it was manipulated when it went through any of those gates. Blockchain and the distributed ledger and this protocol is the next layer on top of the internet that can guarantee the recipient that the sender sent that file and it has not been doctored. Like, that's the power here. Right? So it's like any situation where you need that, like that's where the term trustless comes from. It's like I don't have to trust all the intermediaries in between because of the way that it's digitally signed, the way that everything's cryptographically sealed, the way that it's delivered through these blockchain networks is trustable. Right. We said questions at the end. I appreciate the comments, man. I do. But the thing that really like reinvigorated, so I dipped my toes into this con artist space. Everyone's talking about ICOs, how much money they're making. And then somebody, he was a consultant at BCG actually, Boston Consulting Group. It's one of the big management consulting, probably part of the problem, but also part of the solution in terms. The amount of money that cleared these ICOs in 2017, does anybody have the figure? No? It was around like 4.5, maybe it touched $5 billion, right? But it's all marketing. This is what we see. This is what we in the market see. You know, you see the Facebook ads, you see the Instagram ads, you think the ICOs are where it's at, you think the currencies are where it's at. Meanwhile, the big enterprises, the biggest companies, the big banks, the big financial institutions, Maersk, the largest international shipping company in the world, collectively allocating resources, investing in technology projects, implementing these small beta programs. The amount of money invested in by those enterprises, $37 billion, into figuring out how the blockchain can fix their business ecosystem problems. An order of magnitude more, and nobody's talking about it. This is the next 10 years of technology. There's no doubt.
Exactly. So like, we both believe that we have to lead with the tech and not lead with the currencies. Like, for example, this bottle of water, right? Let's say I ICO this bottle of water, right? And just because I've attached an ICO to this water, does it mean that the value of this water is higher? It's still a bottle of water, right? To me, that's mind-boggling that we've essentially been able to lead with that. So what we're doing now is we're trying to create a shift. I mean, me personally, I'm trying to create a shift by allowing people to realize that the asset themselves are what we need to lead in. But that being said, there is still a huge market of cryptocurrencies out there, and that has value. And because of that volatility, people are trying to figure out a way not to become a victim of the market. So what I've done with my platform is essentially we've allowed people to now take their investments in cryptocurrency and and convert them into art that sustains its value and almost always has a vertical growth pattern, right? So if you're buying into currency that you're worried it's gonna, dip a little bit more than you want, it gives you the opportunity to now transfer that value into, an asset that will sustain its value. And if you later decide to pull that money back out and trade it again, you can do so, right? And by doing that, we actually end up creating that base floor for the market where it's needed or where it's actually wanted, right? So, but this will only succeed with mass adoption. I think this idea of decentralization is a big word that people are using incorrectly, because most of these ICOs are not decentralized. We're talking about the Ethereum blockchain consensus, all these things. At the core level, they're centralized. The only really decentralized cryptocurrency is Bitcoin, right? So, when we're leading with this idea of decentralization, then we have to understand that there's principles and values that come along with that, where you can still have a centralized, business model attached to blockchain, and that's totally fine. But when you do so, there's also, certain shifts that happen in the space that need to be addressed, right? And the problem with a lot of these ICOs that are coming out of, especially the Ethereum blockchain, is that because people are not understanding the basic principles of the token economics, and they were built on already a volatile blockchain that was never stable from the beginning. You're essentially creating a massive marketplace where you're causing extreme volatility, right?
And this is the danger, and this is the danger. The thing that happened in 2008, where the bankers just got a little crazy, got a little greedy, right? People in Silicon Valley often say that like, oh, like Wall Street in the 90s is Silicon Valley right now. It's like, you know, you watch it, but the thing is the drones that were working for those financial institutions are now the drones that are working for Facebook and Google, right? They just read a programming book instead of a financial options book, right? So now you have these programmers that read the abstract of an economic paper and were like, oh, I can build this billion-dollar company off of the abstract. They didn't even read the rest of the pages, right? And so if we're not careful and we don't build these technologies and we don't build these companies in the correct way, in the next, you know, however many years, there's going to be a bigger crash than 2008, built on crypto, the crypto crash.
Thank you. Let's go ahead and open it up for questions or comments. So these valuations and these ICOs, they are absolute fantasies and fictions because there is no exchange on the planet that could support the liquidation. I mean, I get pitched these things all the time. I'm like, where are you going to take your coins to get your $20 million, right? You're going to take it to Coinbase? You're going to take it to BitPay?
Yeah.
Right? They're fantasies, right?
Yeah.
And people don't seem to get the connection. They see these numbers in the press, right? But they don't understand that there's no liquidity.
I mean, listen, like, I think a lot of the people that are like, I want to create a blockchain company now, you know, it's a way for them to be able to get quick money without having to give away equity, right? So fine, if that's the way you're playing the game, then like good for you, right? Like if you're able to get the money that you need, then go for it, you know. But let's be honest, like that's the use case. It's just giving you the liquidity as, you know, a company to be able to do, or as an individual to go do what you want to do. But for the people that are buying into the currencies, the only liquidity is trading them on these exchanges. And, you know, most of us don't have the power of playing the game right. And the reason that you're seeing these crazy pump and dumps happening is because a lot of these tokens are sold during private sales, right, with lockout periods. The second that somebody goes, okay, now I can sell my currency, it's at a high, they sell it all. Because they don't care. They don't care if everybody else suffers. They got in to play the game to win big, just like all of us, right? But when you approach it that way, you're susceptible for, you know, all the risks. And even people that are in the space and are like pretty seasoned veterans, I can tell you they've all become victim of, you know, one of these ICO swings because they think they know it all or they think they can, you know, manipulate the market to their, you know, the point. But really, we don't really know what's going to happen with these currencies.
My question is about this point about the crypto crash. What would you say to some of the folks who are pretty deep in the space and pretty philosophically libertarian who would say, yes, crypto crash, like that was kind of part of the point.
That's what we want.
Was that we would integrate pretty well with the existing financial system, and then it would blow up so that the weaknesses in the existing system would be revealed, and you'd be forced to create something better. Exactly. That this is just the first stage in the ultimate plan. Basically.
Oh yeah, draining the swamp.
Like I mean, but that's what they said, right?
Yeah. Most of these ICOs are self-employed.
I mean, we could talk about, you know, like Shiva being the god of creation and destruction all day. You know what I mean? I don't think it's a good idea. There's ways to create growth without economic suffering. Right? Like Ray Dalio. I mean, Ray Dalio's a big hedge fund guy. He's made a lot of money off of these like rises and falls in the markets. But like in his economic principles video, he talks about that there are methods that we are not using for the inevitable. Like so when you have so capitalism is an economic system built on risk and growth. Right? The more risk you take, the more growth is possible. Lots of people fail, but the one that moves, right, will push us all forward, right? That inevitably creates a sine wave, right? The sine wave up, it's like everything's great, oh, things are happening, crash, right? And the mechanisms, like the strategies that we use to mitigate the suffering in the crashes, you know, like I'm hopeful that blockchain will be part of that story, not part of the story of architecting the rise. Right? Because there are ways to, like, I mean, you know, decentralize.
Right, but I think also the shift of how we decide to, like, tokenize going back to the point of like tokenizing assets and leading with that, where, something that actually has stability, right? I think will create that shift, right? All these massive companies have these crazy balance sheets, right? Imagine if they could tokenize their balance sheets and make money on their existing balance sheets, right?
Yeah, and that's really a positive direction that I see a lot of my favorite companies going towards, is like the disaggregation of pricing. Right, like right now on the public, on like the Dow Jones or the NASDAQ, you have this one price that represents the entirety of a company, right? Where you could create a decentralized marketplace that takes apart that price, disaggregates it into like, all right, here's your access to resources, here's your access to production facilities, here's your access to distribution models, right? You can trade and like gain liquidity and value from each of those disparate parts rather than rolling it up, having incomplete information, right? Because that's really what the market is. Does anybody disagree? It's information asymmetry, right? That's why nobody plays the game, because everybody, well, I mean, like the people that play the game are the ones that know the game, are the ones that get the information. You have like concentric circles of information distribution, and everybody on the outer ring loses, right? So that's not what we want. That's not what we want.
I have one question, but I want to make sure that you gentlemen, yeah, please go ahead.
No, not at all, not at all, no. Yeah,
I mean, that's an interesting question, because I think that there's like a debate there where I was like, do you really want, like the US dollar to crash and burn, right? Do you want currencies to, because what that does is then there's what happens if we can't, pay our military? What happens if we can't pay X, Y, and Z, right? We won't be the strongest. Right, so exactly. So like how do we create that shift? So the way that I think we have to create that shift is by internally, when mass adoption happens and more people start to engage in the space and people start to take on blockchain technology and tokenization, for centralized companies as well, not only decentralized entities, and adopt that, what you're going to see is just with time, it's going to trickle down and create that, that effect where, like you said, we're going to have a less use case for the actual like physical coins and bills.
So there was a great, one of the keynotes that Steve Jobs made. It was when, it's like back in the day where the iPod was just coming out and then the iPhone was coming out, right? The computer was the central hub that all of your iDevices connected to, right? And then when they came out with the iPad, I remember watching it, it's like the animation that was on the slide was like the computer and then these like little things here, like that were connecting to the computer, right? He said, we are demoting the computer. Now it's just a device, right? And what you said in your statement there was like, how do we as a nation move into digital currencies? The nation is just another blockchain, right? So you're going to have the Google coin, you're going to have the Apple coin, you're going to have the US dollar coin, right? And these companies are going to be as powerful as countries. And we're going to give it to them. We as the people are going to give it to them because people distrust governments, people distrust companies, but whichever one of these things, it doesn't matter what label you put on it, whichever one you trust the most to store your value is the one that you're going to go with.
But I think also you'd be surprised the interest that actually a lot of these government entities have in the space, right? We're seeing a lot about, these regulations against blockchain, against crypto, against all these things. But you're also seeing people internally really, wanting to figure out how this could positively impact, their countries, right? For the greater good.
But like civilized society adds a lot of confusion, right?
Yeah.
When you think about it, it's just like the people that run the world are still mafias. The government's the biggest mafia. They're the tax collectors. Pay us for protection. All right. I just watched The Godfather Part 2. I'm really excited about it.
And on that, I'd like to thank Nicolette and
choose
Charles.
one more question.
Right.
Pardon? On the oil coin?
Oh. Yeah. There's a lot of political stuff happening with that, and we're involved with a project where we can't really talk about it.
Yeah. I mean,
but it's dangerous.
Yeah. Well, listen. So, the goal is where tokenizing, let's say like oil, gold, what have you, where getting back to the point where the currencies are backed by those things. To me, you're setting yourself up for failure, right? If you're tokenizing and the asset itself or the commodity, whatever it might be, as the leading tool for whatever, I think that's where it's a lot more effective. But based on the model, I think, right, it's probably.
I think you should probably stop talking.
Yeah.
Thank you, everyone.
Thank you. And we'll take a short break and get started again at 2:15. Thank you. Okay, we're going to go ahead and get started with our next speaker. Our next speaker is Professor Craig Calcaterra. Professor Calcaterra is a professor of mathematics at Metropolitan State University. He holds a PhD in mathematics, is a Fulbright scholar, and a leading expert in abstract dynamical systems and metric geometry. Please join me in welcoming Professor Calcaterra.
Thank you. Is this on? Yep. Okay. It's an honor to be invited to present my views on the applications for business and law to the blockchain, or blockchain to business and law, especially when I'm not an expert in business or law. So my perspective as a mathematician is to look at the entire structure and to see it from an abstract perspective and look at the key ideas that are the crucial elements of it and analyze whether those elements make sense and actually work. So it's going to be much more abstract today than Nicolette and Charles were a little more specific, and especially this morning. And they already illustrated some of the problems with the blockchain, and I'm going to get to more weaknesses, so I'll try to focus on things they didn't cover. But first, give this abstract overview of what the blockchain should be, what its promise is. Then look at the criticisms, and finally, try to argue that reputation in the blockchain is the solution. So right now, the promise of the blockchain, as was mentioned before, is that the idea is that it's decentralized. So what is that? When cell phones started in the 1990s, they posed a massive problem to business that hasn't been answered to this moment. In the 1990s, with large adoption of cell phones, I could have a call, I could contact my friend in China. When she spoke, I would hear her immediately. We could communicate immediately, cheaply, with seemingly no intermediaries, just immediately. And so at that point, the obvious problem is, why doesn't business work exactly the same way? Why can't I transfer money immediately, cheaply, and with no intermediaries? Why can't I make a contract with her, with my friend in China, immediately, cheaply, and with no intermediaries? The blockchain idea is that in Bitcoin is supposed to be the solution to the first one, starts in 2009, so about 10 years ago. And then in 2014, the solution to the second problem of making contracts is with Ethereum. And since then, there's been lots of competitors for each of these solutions. But to this day, we still don't actually see it happening effectively. We haven't conquered the economy with smart contracts and digital currencies yet. But that is the promise. And why is it a promise? It's partly because of the decentralization is what makes it possible. When it's decentralized, the idea is that, well, there's no particular place that we can corrupt, no particular institution that we can hack. And so therefore, it's much more secure against these problems. Second of all, when there is no centralized place taking over 25% or 10% of all transactions, it's obviously much more efficient to go through this route. So this is the promise. Second of all, as it was mentioned many times, it's open, so it's much more accountable, predictable. And we also know that when it's open, the fundamental basics of cryptology is that if it's open, then it's hopefully much more secure, because people have been able to rattle the cage and see whether or not the technology is actually hackable. And finally, it's much more egalitarian. The idea is that it's anybody has access to it, anybody in the world with a connection to the internet. The anonymity that is touted and sometimes criticized is actually one of the just security assumptions that is necessary when you have a distributed system. That anybody could have a fake name, or if they betray somebody one time, they just create a new account and they can betray them again. So it's basically a security assumption, but you can have your identity revealed if you want on the blockchain as well. The next point is that that this blockchain method doesn't actually work so far. So what are the current weaknesses that are going on? So something that Nicolette and Charles didn't mention, so to go in this direction, I think I'll focus on, is that business doesn't work well with the idea of a smart contract. In fact, a smart contract is almost the textbook definition of bad business. So we allow anonymous users or people with fake accounts to have contracts between two people. Even if you figure out who they are, we're going to have a very rigid structure, completely inflexible. It's a programmed contract. And if you violate one term, business doesn't conclude. So we're going to have to make these smart contracts much more complicated. Because everybody knows when we do business, the exact parameters of the contract are not necessarily going to be fulfilled. And if you have two good-intentioned actors, two parties who are actually completely on the up and up and want to collaborate towards a common goal, even if they're good faith actors, something's going to go wrong with the contract. Do we break it? If so, then business isn't fulfilled. So obviously we need to make much more complicated smart contracts. We have to have smart contracts that take account of the fact that when I order some lumber for my fence and the person delivers it, is the exact number of logs that I've asked for going to be delivered? Are they going to be the right side? Are they going to be warped? These sort of things. If anything is broken, are we going to say it's destroyed? No. Hopefully, we'll be able to make the smart contracts more complicated. This is the engineering solution. And if the smart contracts are much more complicated, well, then that also has to be rigid. The code is law that was mentioned this morning has to also include much more possibilities. But if they're code is law, they're rigid contracts that anybody can manipulate and push to the very limit. And the more you add stipulations in your contract, the more people are going to be able to have opportunities to push that to the limit. And if these smart contracts are built with the notion that there's just going to be an asset here and we're going to do business and it's going to be concluded if everything is done perfectly, then the motivation is to try to get as much as you can out of that contract. That's not good business. The motivation for a contract should be that you improve your business. You improve your reputation for business to get future business. And if you don't have that aspect of it, then the actors involved in the game theory perspective are going to try to manipulate that contract as rapaciously as they possibly can, or else they're not good business people. They're not doing it right. But if you add the notion of reputation into this, if you add the notion that there's some history and some future to the value of what you own on the blockchain, then you can change the motives. You can change the entire system from the degenerate system where people are trying to compete against each other when they're collaborating to one where they're actually going to want to collaborate to the fullest extent. So this code is law problem is a real challenge to the idea of how are you going to encourage people to start businesses? How are they going to continue when something goes wrong? And the game plan always fails when you actually meet the enemy at war. So how are you going to continue business? And finally, when somebody really does something wrong and takes advantage of you and takes advantage of a smart contract, either by hacking the smart contract or just by pushing it to the limit and breaking the good faith spirit of the law notion of the contract, how are you going to actually achieve some dispute resolution? How are you going to get some money back when transactions on the blockchain are instant and final and irreversible? So we need to add in some sort of notion of stickiness to your actions. You have to add in some notion of springiness to allow for future and past actions. A second problem with smart contracts is basically engineers, with apologies to the engineers. Now, a cartoon engineer, I've never actually met a cartoon engineer like this, but the naive perspective is that an engineer, and they will always say this, it would be so much better if there were no people involved in our system. Have I not even heard you say that? At some point, the system would work a lot better if there were no people involved, if everything could just run great. And so their perspective is, we want to get rid of the lawyers. We want to get rid of the managers. We want to get rid of the regulators. In a cartoon perspective. Not everybody feels exactly that way. But that is a notion that has been expressed to me many times about the idea, the promise of the blockchain, is we're going to get rid of all the lawyers. So speaking to this audience, when we make smart contracts automated, then there is not much use for you, right? Everybody knows that's not actually true. That's not good for business. The reason the lawyers make big bucks, the reason the managers make big bucks, is because they add value. They've added value from a culture of thousands of years of figuring out how to design good business cooperation contracts, how to make sure that people don't betray each other, how do you make sure that they continue moving forward in the right way. And the regulators have a lot of value to add to this piece. And the idea of programming your smart contract without all that added value is unreasonable. There is always going to be a need for endlessly more complicated smart contracts. If one works, then you're going to want to make one even better. And so you're going to need to constantly evolve and improve smart contracts. And so there absolutely will be a need for counselors who have a good perspective on how to protect their clients' interests. So there's absolutely still going to be a need for lawyers in the future crypto economy or economy. However, it's going to be automated, is the promise. And so the lawyers who actually have those talents will be much more valuable, but the lawyers who don't, it doesn't matter. There's not going to be the need for that many lawyers. So automating your industry is a dangerous sign for you. I guess a few more things about smart contracts is that the danger of the way that they currently are structured is whenever you make a mistake, like if you lose your password or if you don't follow the protocol precisely at the right time, then the contract is over, or else you lose your assets completely. And so this sort of rigid structure is already dangerous. Second of all, the rigid structure, you'll never know whether or not the programming has opened itself to some sort of hacks, even old programs that have been used forever and ever. So big contracts are going to be, people aren't going to be so certain about them unless they've had some sort of bigger structure than, oh, well, I just made this smart contract and the program is really good. Nobody's going to go for that. Next is that no matter how complicated you make your smart contract, in order to handle all the hacks, when you actually program the stipulations of your contract, there's one way, there's always going to be a way to game the system. Arrow's impossibility theorem is the simplest application of this that illustrates that no matter how, whenever you stipulate the ideas of how you're going to actually run the contract, that just opens up an opportunity for people to game the system, to try to push it to their advantage at the expense of your competitor or at the expense of the entire platform, and for you to take advantage. And so you need something that can handle that. And a lot of programmers don't ever consider this as a reality, as a logical reality, that there's always going to be a way to game the system. If you tell me what the rules of the game are, I'm going to push it to my advantage all the way in one direction. And I'll be able to manipulate it if I have a long enough patience for the game in order to win. And there's several other things. So what is a solution to these? There's more, these sort of things. If you have an evolutionary structure, that's maybe the solution to some of these problems. You're going to need this in light of Arrow's impossibility theorem. You're going to need to constantly be able on guard against the changes of the way that people can manipulate the protocols and push against them. And so right now, our current crypto economy, or the way that Ethereum works, has very little opportunity for evolution. There's not a good opportunity for a way we can go in and change the system in a clear, open way. especially for governance, for instance. Right now, a few crypto whales determine Bitcoin. So Nicolette mentioned that Bitcoin is the only decentralized system, but it's got a threat that's famous to its decentralization also, that there are 5 mining pools. So 5 groups are in charge of Bitcoin, which is antithetical to the whole decentralized structure. And they can change the protocols anytime they want, and for their own purposes or for whatever. And so their incentives for changing the protocol are to benefit themselves, the token owners or the miners. And it's very different than the users' incentives. Okay, so there's lots, I guess I'm mentioning these things. And there's also the problem that we were hoping that these decentralized systems are more efficient, but currently, right now, thanks to proof of work, they're not more efficient at all. And as Nicolette and had mentioned also, most of the use cases don't actually use a blockchain. They don't have a good game plan in order to make this work. So, and we could talk about crime for quite a while. that's pretty famous, I guess, amongst the problems. So what are the solutions then? The idea is that you really need to change the dynamic here. You need to change the incentives. You need to change why people participate in business on the blockchain. And so first off, you need a reputational system. And second of all, you need to make sure that that system is evolutionary in the sense that it will properly incentivize protocol changes in order to improve the smart contracting and to improve the governance system to make sure that you're going to win in the future directions of everything. So if you're going to have a reputational system, that will give these pieces of proper incentives. And the idea is that it adds the springiness and the stickiness that is required that's very different than currency. Right now, the way you get something done on the blockchain is you use Ether or you use a Bitcoin. You actually give something that's perfectly fungible. And so when you do that, it doesn't allow the stickiness. It doesn't allow the proper motivations for doing business. One of the problems with a reputational system, though, is that they don't exist. So people would love to have a reputational system. For instance, Amazon.com would love to have a reputation system that actually works. But the fact is, they just did a study 4 years ago that said that Amazon eats about 10% of its profits because their reputation system is broken. That you can game the system. The simplest attack is a Sybil attack. That if I want to sell or buy things on Amazon, what I could do is if I have a seller, I would like to get a 98% rating with 100 or 1,000 purchases. Well, then I create 100 different Sybil accounts, meaning 100 different avatars, meaning 100 different fake accounts for myself, and I just purchase from myself these products, and then I give myself a 4 or 5-star rating, whatever they have, and boom, my rating is up, and now people are going to buy from my product. Or vice versa, I could attack my competitors by doing the exact same thing. I have 100 accounts, I buy the cheapest thing on their site, I give them a 0-star rating, and all of a sudden they're down to 80%, and people will buy out of mine instead of theirs. And so how do you actually do this when Amazon hasn't been able to solve this problem, which is eating away at 10% of their problems, 10% of their profits? They will actually just pay off and give a refund to the customers in order to keep Amazon profitable when somebody is unhappy. And they're not sure if it's the customer or the seller that's doing the problem, that's actually causing the problem in that situation and being manipulative and malicious. Okay. So I've already mentioned a couple of these things. So we need some solid reputational system that's actually going to be meaningful. And we also need to make sure that it's flexible enough that it can react to all these attacks that are inevitably going to be coming. Right now, in the crypto space, a lot of people are ignoring that. They're partly centralized in the sense that they will, they'll protect themselves from the attacks that happen on their cryptocurrency. or their tokens, or their products. And the fact is, instead of dealing with these problems in an evolutionary manner, they'll actually just do it in a centralized manner. So for example, IOTA is a blockchain company that's gonna offer smart contracts and fighting against Ethereum, but in order to keep their consensus protocol going, right now they're on training wheels, which means that they have a bunch of centralized regulators making sure that their blockchain actually works. And so that was supposed to be off of those training wheels a while ago, but they can see that they haven't been able to respond to all the attacks that are going to continually come. And whenever your company is actually worth money, then there's going to be attacks. A lot of the cryptocurrency, or the crypto startup companies, are built in the assumption of idealism, because everybody around them has good faith, good effort. And they're all going to work towards, they all have this common goal, a common dream of making it work. But if the company is ever worth actual money, once IOTA is actually worth the $1 billion of investment that it's supposed to have, then anybody will attack it. And there's a huge incentive to actually use any means necessary, any means possible, to take what you can. Okay, so you need these notions. So I'm pushing a half hour here. Okay. So how do you actually solve Amazon's problem that they haven't solved? Well, we believe you can solve it with the blockchain. And I also believe it's one of the very few things you can actually do with the blockchain. Personally, I've only seen 2 use cases. One is cryptocurrency. A digital currency is a great use for the blockchain. The blockchain's nature is that it has eternal record that is stored forever. And it is stored in a distributed manner on 5,000 or 10,000 or 1 million different nodes, different computers around the world. What sort of information wants to stay on 5,000 computers for all time? It better be simple little pieces. It better be something like the Bitcoin idea, that you've created this digital notion of value, a digital piece of money. And it had better be very easy to store, very simple little transactions. And you better need to know its history. And that's what a digital currency is. You need to know when it was created, who's owned it all the way through, so you can check its provenance all the way back. And so Bitcoin's an excellent use case for the blockchain. Another excellent use case would be if you were going to create a reputational token. For a reputational token, some signifier of value, again, you'd want to know when it was created, why it was created, how it was created, and what it's worth, and how it's changed as time goes by, what it's been used for, and whether or not it's changed its value. And so these are actual things that you need an eternal record for, and you need it to be stored on many different places so it can't be manipulated from one central place. And so that's the idea, is that if you're going to create a secure reputational system with actual value for the money, then the first aspect is you need some sort of eternal record of when those things were created, and we call that the forum. The forum is just the blockchain. It's just the history of the records of the posts of when the tokens were created that represent your value, that represent your reputation. Second of all, you need to make sure that this reputation actually has some meaning. You actually have to fight against the tragedy of the commons. Melinda was talking about the social commons. It's a concept from, as she mentioned, Roman times, where there would be these common social areas. And the tragedy of the commons, different than what she was talking about, is that if it doesn't mean anything, if the commons are just free for everybody to use, what happens is the local farmers bring their sheep in and they shit all over. Forgive me for being blunt. But that is exactly what happens. That is exactly the explanation of the tragedy of the commons, is that if it's not meaningful, then people will abuse it and won't use it properly. So we have to have some sort of notion of validating it, of making that reputational token mean something. And so you have to be able to lose that token if you're going to have a meaningful reputational token. So in a decentralized situation, in a distributed situation, it has to be democratic. So we're going to have to vote on it. And the validation pool, in order to guarantee against Sybil attacks and tyranny of the majority, has to actually be that you not vote with one person, one vote, but you vote with as much as reputation as you want to commit to it. And also when you have this notion, if there's a validation pool, it will prevent what are called liveness faults in distributed computing or that sort of thing. It means that the people are guaranteed to participate in the creation and valuation of the reputation. Finally, number 3, you need to make sure that the value that comes in is not just reputation, but actually that what the reputation comes from is when the fees come into the platform, then you give them away to everybody according to their reputational holdings. And that's the notion that the reputation then gives you long-term value, gives you that springiness. You're going to look forward to the value of your reputation, and you want to keep it. You don't care about losing it and just selling it to somebody really quick. That the real value of the reputation actually comes from whether or not the fees come in. And so as such, you need this foundational token value, which means that you don't create a token unless it's attracted a fee. So even if you're going to develop something and add value to the platform, if it doesn't attract a fee, no tokens are created. So the fees have to be created when, the tokens have to be created in proportion to the fees that come in. But that doesn't give much incentivization. And the balance says that when they come in, they can't come in, you can't just guarantee, you can't just pay for fees. You can't just pay for reputation with your fees, or else that would open itself to a 51% attack. So when they come in, the tokens have to be minted 50-50% and staked half and half on the up and down votes. Not always, but. And finally, to make sure that the developers are actually incentivized properly. When they add value to the platform by creating smart contracts and that sort of thing, we have to be able to review that effort so that later when fees come in, we have to be able to give fees to the people who actually created the value in the system. And so for stability, we have to make sure that this validation pool where everybody votes on whether or not your contribution to the platform is actually valuable, it better be stable. There should be some protocols that indicate that when you do something that everybody agrees with, then everybody should vote in favor of it. So we shouldn't be losing 10% of the tokens each time we have a vote. That would be completely unstable. So basically, you're going to be wanting to have unanimous votes almost every single time. And the voting, the validation mechanism is simply for consensus, simply to make sure that your DAO is running properly and that everybody is doing what they're supposed to be doing. And it should be automated as much as possible. So that as long as you're just running the computer program that checks on people properly without editing it and faking it, then you should be able to win every validation pool in order to keep perfect consensus amongst the DAO. Okay, they're indicating that's my time. I guess we'd have questions and that sort of thing, but
let me. Craig, we're stretching some people in the room.
Yeah,
we're
no,
talking
absolutely.
crypto talk, and not everybody is crypto. So,
Right.
Why is reputation a key ingredient for the crypto evolution? That's core, right? So that's what we're claiming here. There is no true crypto evolution in decentralized, autonomous, and anonymous systems without reputation. Why? People, there were some answers there. Sir?
I mean, if you don't have trust, you have no market.
Why not?
Because no one will put money into it, no one will use it.
It's actually worse because we're talking about anonymous systems that are fully decentralized, right? So how do you trust somebody whom you can't know? You don't know their history, you don't know their identity, you don't know their citizenry. If you can't trust them, are you incentivized to trade with them? No, you're not, right? So there needs to be a mechanism as a proxy for trust, and that's reputation. So then the question becomes, how do you set up a evolutionary reputation structure that gives people reputation stakes that other people can trust? Yeah? And how do you engineer that? How do you set that up as an architecture, as an infrastructure? That's what this is about.
Is this a separate trust paradigm than when you talk about trustless transaction?
Yes, in some sense. So actually, Christos of trustless transactions in reference to, are you saying like consensus on the internet as we move our packets through the internet, or what sort of trust example do you have, trustless? Oh, I see. Yes, it's very different. So smart contracts are sort of trustless in the sense that they're going to compute in a certain way that you can check that it computed properly, and there's no need to have reputation whatsoever in order to determine it. It's just automatic. It's just mathematical as to whether or not the transaction goes through. And so it's very different. If you have a reputational component to it, then you are putting up stakes. You are saying that if I don't do things according to spirit of the law projects, spirit of the law perspective, then later on I could have my reputation slashed. Even if I follow all the rules, but I'm gaming the system, if you have this notion for review of the reputation, then you could actually lose that in the long run if you're violating the spirit of the law that the DAO, that the organization agrees on. And so that notion is very, very different than code is law and trustless actual smart contract computational trustless systems.
So I wanted to ask a question about the trust thing, or at least give an example of a system that is completely anonymous. I don't trust it, and I have no choice but to use it. It's called the Chicago Board of Trade. And it's the only place that I can actually get a price for corn and soybeans. And the reason I'm interested in blockchain is I would be very happy to have a system that I don't trust. I don't have to trust anybody else in the market. I just have to know what's the price, and am I going to get that price? So I don't know that trusting, and the thing with blockchains is I can download the code, so I can trust the code. Mm-hmm. And I don't necessarily need to have a reputation system. I just need to know that I just need to know that I can exchange the cryptographic key that I have for money.
Right, but so in the Chicago Exchange, it has some trust, even if you don't understand it, even if it's opaque, right? It has a history.
Legal guarantees. Yeah. Settled. That's trust by way of intermediation.
I cannot participate as a farmer in that system unless I file a class action lawsuit. And I can give you some examples of where that system has been diverted. And the only people that made out well were the lawyers filing the class action lawsuit.
Right. And so that's a problem with existing systems, right? And that's one of the promises of the blockchain is to open that up and make it a little more transparent. So that, and also that you can participate in it. In a reputational system, you can participate in it according to your ability to participate in it. You'll get rewarded according to the value you actually add to it. You'll actually then be rewarded properly, and you'll have the right reputation that goes along with you, instead of going through the opaque, convoluted layers of working your way through power in order to become a powerful executive in any particular branch of our society.
It's pure peer-to-peer through reputation. That's what we're talking about.
And much more meritocratic,
I think.
in a sense.
So it seems to me like you're talking about, with cryptocurrencies, it's an even exchange of value. There's no value added. You give this and someone else gets that. But what you're talking about is where there is a value add, where there's some kind of something extra that someone adds to the transaction that is not completely objective. Is that true? That's why this system is what you're advocating for with this validation pool and other pieces of it?
Well, the idea is that you would still get rewarded, but you get rewarded with the money based on your reputation. That the DAO would be organized in some way, that the fees that are come into the DAO would be split amongst the people who have power in the DAO, and the power is reputation. And so it's not that reputation isn't valuable, but it is true that, as you say, it's a way of making it a little bit spongier, making it so that when you actually create value, it can be reviewed and checked, and you can get rewarded for that later, instead of the immediate benefit that the platform gets. So that everybody can be rewarded fairly, and that you can actually motivate good behavior within a DAO, instead of the degenerate situation where everybody just is rapacious and trying to get whatever they can from the system if it's just purely motivated on completely fungible currency.
While fully incentivizing that individual.
And the fungible currency.
So I have two questions. First is just one of clarification, because I use the language of a DAO. Is this a DAO sitting on top of an existing protocol, or is it a new protocol?
So it's a new protocol,
Okay.
and DAOs can sit on top of it.
Okay, so that was just a clarification. The second question, I think, gets to some of these other questions people have been asking. When you talk about reputation being the next evolution in blockchain, you mean to say that you're creating a protocol with an advanced form of on-chain governance, no?
That's an aspect of it, that's right.
Okay, so it both facilitates trustless transactions the way we think of in Bitcoin or in Ethereum, going to the earlier question, but it also incentivizes on-chain governance in a way that we don't see in Bitcoin or Ethereum. Am I understanding this correctly?
I suppose that is possible, to be honest, and I don't want to say that, because my motivation is to make it more transparent, that within a DAO, that you would have a transparent method within those members to argue, and that the way that they would actually create governance is through their reputation. And so in order to create these protocols, you'd have to have on-chain evidence of the development of those protocols and the arguments about those protocols and all that sort of thing.
So then I go back to the first question. I'm going to need you to re-explain it then. Why you do need reputation to do that? Because there are DAOs like Dash or others that have come up with on-chain governance rules to regulate themselves that have nothing to do with reputation. It's all voting based, for example.
Right. So we're analyzing that, and the problem with all of them so far is that they have many well-known problems with it. I can go into many, many problems. So one of the problems are that basically if you use your tokens in order to determine what the protocol upgrades are, then that gives particular incentives in that DAO towards the token holders, instead of the miners, instead of the actual people who do the work in the DAO, or the developers who actually create the value of the thing. And so the idea, that's just one little problem, is that the incentives are wrong when you use Dash's method of just using tokens. And Ethereum did the same thing. The token holders would decide on the next protocol upgrades for how fast they're going to change their transaction rates and that sort of thing.
One quick question. On two of the use cases.
Precisely. Yeah. I could repeat that for everybody if they didn't hear it. But so he was saying that he was elucidating what I didn't explain very clearly is that this is a process that people in different DAOs, that people in different organizations can use to make things, well, I keep saying more spongy, but that will guarantee that people can cooperate in a way that will motivate them towards the good of the group instead of their own personal good. Because that way we can, the idea is that you want to make sure that your reputation is valuable so that you can attract the fees. And your reputation is not valuable unless your organization is attracting fees, because the reputation is only good for serving you the salary, the fee-based salary that's based on your reputation. So it's just one more aspect of it.
I wondered if you could take this on a couple of different use cases. The first would be the use case for customs declaration and movement of goods across countries, and bills of lading and letters of credit, and how this would apply in that situation. And then related to that, well, I mean the actual technical, making sure that you've got your bill of lading when you're clearing customs and building that into the system. And then related to that, if you are involved in the manufacturing of goods and you are using blockchain to deliver, and forgive me if I'm using the wrong terminology, but to deliver your intellectual property to whoever is going to do the manufacturing, to build a system into that so that as you deliver that IP for the manufacturer, you still control it, but then it somehow becomes using either the reputational system or just some other system that a third party can verify what you were building, that it falls within customs classifications, and then ease the process of moving goods across borders.
Yeah, I think in order to do that, it would have, at least currently, you'd have to, maybe you should take this one, you'd have to make sure, this is a complicated problem because you're talking about transnational borders, and we're coming up against the law where I'm admittedly not going to be able to handle this, that whether or not we can create that, I think the law would have to create that right now because they're in charge of it. It's their jurisdiction. So they would block the transference of goods across borders. I am not seeing a good use case for that piece. Then you were mentioning IP in a company, and so that we could have development, and you could have a DAO that's devoted to developing your technological product and then actually selling it to actual use cases. And so,
Go on.
and so if you are creating this DAO, this distributed autonomous organization, for people not into the, sorry, the acronym there, would be devoted to developing products and actually creating a protocol for actually achieving fees by selling it to the right people. And it would properly motivate the people who are developing it because the reputation that they create at that point could be created before the actual fees come in. So they could actually distribute the reputation properly according to what they've actually added to the company. And then when they actually finally sell the intellectual property and their products to another company, then the fees come in and it properly rewards the people who developed everything.
So just a quick addition to that. So in supply chain, international supply chain, there are multiple levels at which reputation verification intra-supply chain is relevant, as well as interfacing with regulatory authority. But we're not there yet. So intra-supply chain companies, yes. Interfacing with regulatory authority, that's what Ray's talked about, no.
Yeah.
Not at this point, yeah?
That's,
so
what I
that's
was
the
afraid
point.
to answer
Right,
that
right.
cross-border
exactly.
question.
Yeah. Yes, we'll take a 5-minute break and then do that. Yeah, we'll just sit up front, and then go take from there.
Nothing, I'm sorry. The answer to both of those questions. The idea is that this is reputation based in a specific domain of the DAO. And so you have reputation tokens within your organization that has gotten together for a common purpose to collaborate towards a particular goal. And so everybody shares a common mind to achieve that goal is the simple use case to begin with. To actually handle something like social-wide thing, that's a sticky situation. Yeah. that's a good point. I just want to repeat what you said, which is the idea is that reputation tokens are created at different places, and they have their whole history, just like Bitcoin has its history of all transactions. And so when a token was created, it was created associated with one particular action. And so you can criticize that action to remove those tokens. But you only remove those tokens. Unless you can criticize every action that person has done everywhere, their reputation is not completely slashed, just because everybody's ganging up on them. But if they wanted to gang up on them, they could attack everything they've ever done. They'd have to be completely motivated to get them out of the DAO. Right, right, that's right.
Or even, and look at what is done, and I know it has stored with many consumers, but look how critical it is from both sides. Take the experience, right, all of the consumer reporting aid. So I think that for trustless transactions, to go back to your question, the trustless transactions that we have mostly been accustomed to in the blockchain is because of the digital currency. So it is instantaneous, and you say, if I give the dollar bill, you don't care who I am, as long as it looks up in the line, that it has the safety thing, you know it's the same dollar everywhere. However, on many occasions, now, think about how disruptive it would be if somebody were to offer something to the forward markets for futures and so on. That was not bad. That's why all of these exchanges and all of these, when people are allowed to trade and set prices, there are very serious penalties if you don't make good on your product. Because even if you take the case of a digital contract, a smart contract, even if it's protecting, let's say, the front of the goods, right? And it protects me that it's not going to release my payment if the goods verify it come to me. I still suffer tremendous damage if I order something from you, and I'm sure we have all experienced it on Amazon, for you order something, they give for the person you love, and then they say, oh, sorry, we can't deliver. Right? So all of this, reputation in all of this has very significant issues. In fact, just to give you an example of reputation, which is a very important point going on, you're showing us now anyway. So switch gears quickly. Chris is on, our next speaker. Mohammed will introduce him. We'll switch the slides, and then we'll get to the conversation.
You just want me to use the presentation that you sent me. I'm sorry? The presentation you sent me with Samada.
No, and it's not like the Wheel of Trust either.
Is it like Konya?
Coin?
Konya? The German, I mean, where you basically you promise you're going to create stuff in the community like bread or whatever, and you create coin that corresponds to that.
So what is that called? Futarchy or something like that?
Yeah, kind of.
Yeah. No. Again, it's like.
So how is it different from backfeed?
Remind me how backfeed works again.
What's reputation-based on-chain governance, essentially? So that's the question.
Right. Let's see, I'm forgetting which one they are. Oh, thank you.
go ahead and get started with our last panel for the day. First, we have Mr. Christos Polyzois, who specializes in helping companies navigate market disruptions introduced by new technologies, and Mr. Yuriy Sherayzen, CEO at DAppMind, a Minneapolis-based ICO marketing and DApp development agency. Please join me in welcoming them.
Is this on? I think. Okay. Oh, sorry. Good afternoon, everybody. You want to? Should I? No, I was just checking the mic. Okay. I first want to start from where the previous discussion ended, and fundamentally, if one thinks about trust and about trust is essentially common belief. And everything that we even take on the basis of some document or something, even your identity, can be traced all the way back to some probably doctor at a hospital signing a piece of paper that you were born, right? So everything can be traced all the way back to how many people and how credible people can vouch for that piece of information. So the distributed ledger technology or the blockchain technology is essentially a consensus technology. It's a technology which achieves shared beliefs, and the reason they are immutable is because they are shared among many computers, among many entities, and therefore no single entity can undermine the truth or can alter what that shared common belief is. So in that sense, it is very important to be able to reach consensus. And consensus can be achieved. These are well-known technical problems. And I come from a background very similar to Mr. Huang's earlier. Right? I think it is almost unfortunate that there's this conflation between cryptocurrencies on one hand, which are a very convenient use of the blockchain technology, and the more general blockchain technology. So here I'm going to talk more abstractly about the general distributed ledger technology and the need to reach consensus. And it is very interesting that how quickly and how efficiently one reaches consensus in these very highly distributed systems is critical for the performance of that system. And as you probably most of you know, today one of the biggest problems that we are facing is the problem of the transaction throughput that could be achieved through the previous generations of blockchain technologies. Right? So some of the things, I can talk about how one could view this to give you a sense about what is under the covers. One of the interesting things is that, yes, Bitcoin and subsequent blockchain technologies have brought to the limelight technologies that have existed for decades. In fact, I happened to attend a talk by Yuriy the other day, and somebody asked me, okay, how do I go about this? And he said, look, all programming languages, he gave a great analogy. He said, all programming languages, they have 3-4 basic constructs. They have a loop construct, an if-then-else construct, and so on. So the basics do not change. So similarly, the blockchain technology has been using concepts that have existed for quite a while, whether it is the non-reversible, not easily reversible computation when you compute a hash, right? So that is essentially a one direction. You can very easily compute in one direction, you can't come back, and that ensures you cannot alter things. And protocols for distributing the information and making sure you get a consistent view of the system. So what I would like to do here is to a little bit debunk, if you will, the technical myth about what underlies all these applications and show what is essential and what is critical and how it could be implemented, how it could create value, and link essentially the infrastructure of the blockchain technology to some of the applications that people have talking about. Does that make any sense? I see people nodding. So if we go, is there a clicker? Or can I go to? Oh, okay. Very good. Thank you. So I will use Samada as a case study, if you will, right? And how one could go potentially about implementing something like this. So here is how one can think about the blockchain technology. Remember, it's information that is distributed and ideally identical. Now notice that agreement, a consensus, or perfect replication in a distributed system is extremely difficult. Replication, I always say, replication has two children, a good child and a bad child. The good child of replication is redundancy, is resilience, right? That's how we get resilient, because we have all of these copies. So if one tries to alter a copy, it will be caught through the other copies. If one copy gets lost, the other copies will survive. So that's the good child of replication, and that's something that blockchain technology uses, right? It replicates the same information everywhere. The bad child of replication is inconsistency. If you have only one copy of something, it may be wrong, but it can't be inconsistent, right? If I have only one entry in my Rolodex for your phone number, it's not inconsistent. It may be wrong, your phone number may have changed, but it's not inconsistent. The moment I start keeping multiple Rolodexes, I may get inconsistency. So as we go forward, keep these two things in mind, right? So we are trying to achieve replication and consistency, right? We're trying to achieve, redundancy and consistency through the replication. So being able to reach a consistent state in the system is critical for everything in blockchain. If we don't have, and remember, all of the attacks that are mentioned, even about cryptocurrencies, the best known application, all of the attacks you hear about is the double spending problem, right? Where this node thinks that I gave the money to Alice, and this node thinks that I gave the money to Bob. So at the bottom, fundamentally at the bottom of a blockchain infrastructure, one has the basic computing resources, the basic computer resources. And the three types of resources we have are computing, cycles, storage, disks, memory, and so on, and networking. And those are basic ingredients. It's like making a cake. My advisor, a really famous person in IT, used to say that, these systems are like cakes. They all have the same ingredients: milk, butter, sugar, right? A good cake from a bad cake is how you put those ingredients together to create the functionality. So above that, one has the blockchain, the core, if you will, blockchain functionality. So think of that layer as a layer of software, and that's exactly what the various systems do, which takes the basic computing resources, takes the storage, the computing, and the network, and ensures that the information is replicated across all sites in a consistent way. Does that make sense? So the basic functionality, if you think about this, the basic functionality is take this information and post it. Post it in a way that is immutable, and it cannot be indestructible. So then, on top of that, one can have two types of, can start building applications, right? So that could be. Now, the interesting thing, if I go back, notice that based on what Craig was saying, and this is a very interesting thing, Craig was talking about reputation, which eventually drives consensus, right? That's a way to drive consensus on somebody's worthiness, for lack of a better term. The exact same thing is true in a self-similar way for the information that is posted on the blockchain. Does that make sense? So exactly the problem that we have about somebody's, let's say, creditworthiness is the credibility of some information. Is it true or is it false? And what the blockchain does is create this consensus whereby having multiple independent agents, it becomes very difficult using well-known protocols to forge that information. So the mechanisms that Craig was just talking about can be used in a self-similar way to also implement the blockchain infrastructure itself. So instead of just agreeing on somebody's credit score, we can agree on the information's credit score, if you will. Is it true or is it false? Is this transaction legitimately in the blockchain? This allows, so once one has the basic blockchain functionality, one can start put in traditional, if you will, blockchain applications, applications that just invoke the blockchain. And these could be cryptocurrency applications or other applications, right? So at that point, there would be a blockchain API, and that is what would tell the system, take this information and make sure you memorialize it, right? And one can have two, if you will, types of applications on top. There could be traditional blockchain applications, existing, I should say, which could migrate to this system because of the higher efficiency. Remember, what is very critical here is the efficiency with which that blue layer operates. The efficiency and the speed and the transaction rate that one achieves. And that is, it turns out, and I'm not going to go into the details, but it turns out that the reputation algorithm is a very effective way to reach consensus in a distributed system. Right? So one of the nice things of these reputation algorithms is that when it is applied to ensuring the credibility of the information, it is much more efficient than what people do today with mining, where essentially they are given a very difficult mathematical problem to solve. So the other type of application now that opens up, still with a fundamental blockchain interface, is new transactions, which today could not happen because the requirement for throughput exceeds what is available in existing blockchains. The moment one is able to raise the transaction rate, one can run new classes of applications that were not previously feasible, right? And from what I have heard, it really, to somebody with a background in high performance transaction processing systems, the numbers are really pathetic, right? In the teens of transactions per second, when 30 years ago, American Airlines was the first company in the world to break the 2,000 transaction per second barrier, right? It was like breaking a supersonic barrier. And that was back in the early 80s. So 30-something years ago, it's in the books. So there is a lot of room there for improvement, and I think that the reputation algorithm will help achieve that. However, on top of that, one can not only use the algorithm this approach, the voting approach, the reputation approach, if you will, that Craig was mentioned, can not only be used for the information on the blockchain itself, keeping the blockchain blocks, creating consistency on those, creating consensus on those blocks, but one can expose an interface and allow applications to use it on top. And that's where one could build the equivalent of whether it is a credit score, whether it is the information necessary to participate in an exchange, or whatever that information could be, right? And whether it is the information, are you an expert and be able to resolve disputes, et cetera. So that information would give rise to the voting API, which then would open the path. Now, this is, remember, not just, think of the excuse me, the blockchain as like an operating system, right? So there could be a service that is offered by the operating system, that's the raw interface, and then you could have an application level interface which could say, okay, I want to run the voting algorithm so that I can create consensus on this other topic. And one, again, could have two types of applications there. One could be, of course, applications that Semada could build itself, right? And again, even that would have two subcategories, because there could be applications that could use the consensus algorithm to disrupt existing markets, or there could be completely new applications that today are not even at all feasible, because we don't have the equivalent of this in the physical world where we can achieve very quick consensus. Remember, computers can achieve very fast consensus. It takes a lot of messages, but they can achieve consensus very quickly with some of these protocols. And of course, it creates an opportunity for an ecosystem where anybody could use the same algorithm that would be embedded also in the blockchain and exposed to the application level. Third-party applications, anybody could build their own favorite application using that protocol. A little bit about the dependence and how people could think about this is, the most critical part here is to design and validate the distributed algorithms. And that sounds, what in English sounds like a trivial task, like replicate something across all nodes, is notoriously difficult in the presence of messages that may be lost, or even malicious messages and so on. So these are notoriously tricky algorithms to get right in the case of failures. And I will draw an analogy with contracts, where you write a contract with the expected sequence of events, and that's easy. It's all the exceptions that get you and eventually invalidate the contract because, oh, we never thought of this. We didn't anticipate that. So it's all the unanticipated events. So once these algorithms are designed and validated, and by the way, they could be tried initially on top of another blockchain, right? Remember, these are the core algorithms. These are the fundamental algorithms. They could use any other blockchain as permanent storage. Then one could embed the algorithm, and once the correctness is verified, they can be embedded into the operating system, if you will, of the blockchain layer. And at the same time, create the API to enable the third-party applications, which would enable other parties to write applications as well as Semada, and while at the same time, the blockchain layer itself could evolve, right? And none of all this all of this requires very thorough engineering work, but it's not, it's not rocket science or anything. These are well-known concepts. And in terms of how one would go about this there is kind of a similar staging, if you will. The first staging is always to create an architecture for a system. Then you implement and you verify the algorithms. So then you test and you verify the algorithms, you design the algorithms. And then you implement with all the details to make sure they are robust. And in the first phase, one could develop the algorithms and possibly, as I said, using the blockchain services of another blockchain. Think of this as if you want to develop a new operating system, you can use Windows to run your compiler, right? You can develop it on Windows, and then you move it down to the kernel, or use Linux or something. So the second stage is while, and notice here the dependency, that while you're always looking half a step ahead, because the next step is, even as you develop the basic algorithms, you're looking further ahead how they will be implemented and be inserted into the core layer of the blockchain. You do the same thing, a self-similar structure, these overlapping phases for the implementation of the more elaborate algorithms that Craig was talking about with weights and so on. So I don't want to get too much into too deep details, but if anybody has any questions about how this could be connected to the applications and what one could do on top, I know Yuriy is going to talk about how you write code on top of all of this, right, and how you would use the language. Yes?
Thank you so much, both of you. Microphone coming here again. Dan Dashfield here at the school. Very curious, because of the scale or the scope of this project, it's so ambitious, it's so universal across the blockchain space, ideally, hopefully. How does that change your leadership strategy or your marketing strategy, or how do you achieve that mass adoption that would put Semada on the map, so to speak, as the trust or the reputation backbone?
Mm-hmm. So there is no substitute for, as they say, I have a better mousetrap, right? So if we are able to get the transaction rates that we should be able to get, think about it. And actually, that shows the vulnerability of currencies, if you will, that are not based on a diversified pool of assets, right? Currencies have value because of scarcity, right? And utility. The only utility that currencies have, like Bitcoin and so on, or Ethereum, is that they have an algorithm that works. The moment you have a better algorithm, right, the value migrates here. And I will keep emphasizing, going along the same lines as Mr. Huang, that there is a tremendous demand from applications outside. Forget cryptocurrencies, right? They're one only. Remember, even when Wolf showed his slides, the financial world was only the first category. So once you see the entire ecosystem, the 37 billion, right, versus the 5, and you see all of that, I think that people are actually now constrained by the fact that they do not have the transaction rate. People are asking for this. So people are coming and knocking on people and saying, okay, who can solve that? So it's actually real demand, believe it or not. This is not going to rely on some scheme with tokens that people are going to quickly try to unload. The value of this is intrinsic in the efficiency that it creates and the scalability in terms of transactions per second. Actually, that brings up a great point, which I didn't want to interrupt the previous discussion. How many people know how many Bitcoins will ever be printed, ever be minted? Yes? 12? 21, sorry, yes. 21 million, yes, thank you. So how many people know, yes? Okay. All right. But excellent, excellent. Now, what are the holdings? What are the holdings? What is the balance sheet of the Fed? Yeah.
Sorry.
Let me answer this question.
Sure.
What is the balance sheet of the Fed? I have no idea. Does anybody in the room know what the balance sheet of the Fed is? Trillions, correct. It's 4 plus trillion. 4 plus trillion. Now, why do I bring this to governance and what Wolf said? During the Christmas season, right? If you have something as hard-coded as 21 million, the money demand during the Christmas season because of the economic activity spikes like this. If there was no some kind of governance to ease that demand through additional supply during the Christmas season, you would not be able to buy gifts for your family. The dollar, the prices would skyrocket just because of the demand, right? You would not be able to afford those. So the ability to even somehow have this governance that will allow, and I'm taking the trivial case of cryptocurrencies, right? The ability to have something that will correct or will adjust to fluctuating needs is extremely fundamental. And the people who think, code, oh yeah, we're going to do the code and we're done. Correct.
And they don't have an evolutionary protocol upgrade system. Yeah, so there are other people are trying it, but they fail. They're not secure. They're not evolutionary, and those elements are needed for crypto evolution. At least that's what we're.
Thank you to all of our speakers. Oh, sorry, that's really loud. We'd like to thank all of our speakers for joining us today, and thank you all for coming and for the event sponsors.
I think Yuriy is still.
Yuriy.
Yeah.
Sure.
Yeah, so I'm gonna riff off of what Christos has been saying, and I come from the perspective of someone who really focuses more on marketing, and at the same time, the questions such as the ones that have been kind of talked about so much, how do you trust any kind of system, and what is the purpose of these tokens, and what's going to be the value of them, and things like that. I think they come up all the time. And in fact, pretty much every project out there right now is really scrutinized, a lot more than it used to be. It was so much easier probably a year ago to promote any kind of project, like a crypto project, because people are just not as informed, I think, and it was just a really kind of a premature thing to do at that point. But right now, it really is a huge question. Like the question of what happens to the tokens? How does this whole system? How's this system going to work? A lot of projects out there claim that they're going to, revolutionize things and transform and so forth, decentralize. Through all these big words. But really, it does come down to the fundamentals. So that's why I believe a project like this. Kind of an infrastructural project that focuses more on the fundamentals and solves the fundamental problems with not just even just the blockchain itself, but the world in general. Like why do we even need this system? That's why it's so critical. And the terms such as evolutionary updates, I think, are really really important because solving all these issues that have been mentioned. They're essentially kind of like a next. They seem to be the next kind of loop in the spiral of the upward spiral of the evolution of the blockchain system. It has to be faster, it has to be able to, do more transactions. Right now it's kind of slow. And like at least if we're talking about Bitcoin and Ethereum, and of course they're perfectly aware of that. And so, and that's why like I always look for, at least when I evaluate projects, I always look for those types of things. I always want to focus on, even if it's, let's suppose, even if it's not an infrastructural project, more of a DApp project, or it's a platform or a marketplace or anything like that. I was asking, like, how's this whole thing gonna work a year from now? What happens to all these tokens that you're releasing? How can people trust this company? I mean, when all people can go off of is, just a bunch of LinkedIn profiles of the founders and the claim that, they have a new interesting something that's gonna work. So yeah, so like all these things, I believe are critically important, and they're important not just because it's such a critical technology, but also it's just important because it's important to it's a question of fairness and trust, and how can like a token ever be something that people can actually believe in as either it's a utility or it's a security or whatever it's going to be, or a hybrid of both. So there has to be like a better solution. Has to be a better solution to to the issue of trust. So that's my 50 cents or whatever, 2 cents.